It's not only should be a central part of your portfolio, but it is a central player in, I think, creating the new financial system. Bitcoin is one of the few things that in a trustless world is very trusted. The blockchain is really secure. So to me, Bitcoin getting to 200,000, I think is an inevitability. I'm expecting it this year, which means there's still a lot upside. So there's like 4 or 5 arrows behind Bitcoin. All of those are signaling upside right now, because we know the Fed, even though they're on pause, they're dovish next year. Bitcoin already prices in that, and that's a positive tailwind.
Bitcoin is on track to hit $200,000 by the end of this year, driven by growing institutional adoption, global liquidity tailwinds, and a surge in investor demand as traditional assets continue to lose appeal. That's the latest projection from Tom Lee, co-founder and head of research at Fundstrat. Lee and his team have backed Bitcoin for nearly a decade, not just for its performance, but for what it represents: a shift toward a new financial system built on code instead of trust. In a recent update, Lee highlights 4 major forces behind Bitcoin's growth: rising global liquidity, increasing investor risk appetite, strong on-chain fundamentals, and accelerating institutional adoption. With the Federal Reserve signaling a more dovish approach, all 4 drivers are aligning. Lee believes these conditions could push Bitcoin to $200,000 by year's end. Make sure to stick around until the end of the video as Tom Lee, joined by Fundstrat's head of technical strategy Mark Newton, breaks down the signals behind Bitcoin's next move and explains why $200,000 might be closer than most people think.
For the last 9 years, we have been advocates of Bitcoin. We think it's important. Bitcoin is part of our millennials theme, and it's also part of our cybersecurity theme, because those are really the 2 areas that Bitcoin really resonates with. If you're older and you don't trust Bitcoin, it makes sense because Bitcoin is very popular with millennials. And if you think the traditional banking system works well, it does, but it is really only designed for wealthy Americans. But the large banks are starting to actually incorporate Bitcoin and crypto in their trading offerings and their bank offerings. I mean, stable coins are going to be one of the key on-ramps into crypto, and almost every major bank is trying to get into the stablecoin business. Look at BlackRock today buying 10% of Circle. So do I think Bitcoin is important? Yes. And it's going to be a treasury asset going forward. So even S&P 500 companies are going to own a little Bitcoin. So yes, I think we want to have exposure to the right businesses in Bitcoin related companies. I mean, JP Morgan is a granny shop, but it eventually has Bitcoin exposure too. But I mean, MicroStrategy is a pure play for obvious reasons, and Robinhood, of course, is really the new Morgan Stanley.
Tom, in your video, you mentioned Bitcoin all-time high as a leading indicator for the S&P. If Bitcoin continues to reach price targets of 250,000 and higher, do you see this correlation continuing, or do you anticipate they eventually diverge?
Great question. I would advise against trying to put a ratio between Bitcoin's price and the S&P price, because that's not the relationship we're talking about. Rather, we're saying that Bitcoin is very sensitive to global liquidity and risk appetite for investors, which is separate. So let's say there's global central bank liquidity and there's risk appetite by investors. And then there's Bitcoin fundamentals, which is adoption of wallets and activity per wallet. And then fourth, now I would add, is the institutional adoption of Bitcoin, which is treasury and pensions and governments adding exposure. So there's like 4 or 5 arrows behind Bitcoin. All of those are signaling upside right now, because we know the Fed, even though they're on pause, they're dovish next year. Bitcoin already prices in that, and that's a positive tailwind. And so to me, Bitcoin getting to 200,000, I think is an inevitability. I'm expecting it this year, which means there's still a lot of upside. And as Mark said, that means there's a lot of upside on Ethereum. But I don't think that if Bitcoin gets to 250, the S&P doubles from here. I think the S&P goes up a lot. But I mean, S&P getting to 6,600, that's a huge move. I mean, that would shatter most people's expectations, because Mark and I know when we talk to our institutional investor clients, most are cautiously positioned. They are very skeptical of this rally. They think it's a bear market rally that might just stall at the old highs and we make potentially new lows. But I don't know, Mark, what's your thoughts?
I'm optimistic on Bitcoin's progress and its potential for this year. It's tough for me to say just now that it's going to go straight to 250. I think that there needs to be, we've had obviously a big move up since April, and so not to be too short-sighted, but I do sense that, sometime in late June, July, you might see a little bit of a little bit of consolidation, and at that point, the log charts are still quite optimistic and it is proper to look at, assets like this that have such huge dollar values, really. And when you connect the peaks going back from like 2017 to 2021, that hits up near like 275, 285 at the highs of that. And so, that would be a realistic target eventually that I think it would get to. But to say it goes there immediately this year, I mean, I put out the beginning of the year 135 to 150. I'll stick by the 150. I think that's probable. If it gets above that, depending on what type of consolidation we see, probably in late June, July, would really help me to be able to narrow in on being able to find a more precise technical target. But I do like it and own it. I would just watch the relative strength of Bitcoin, because you might see other things like Ethereum starting to gain traction, and that's close right now to breaking longer term trends versus Bitcoin, and that's sort of interesting to me as it starts to gain strength.
As you know, the S&P went into a tailspin on fears of Tariff Liberation Day. It was a waterfall decline. There have been 18 such waterfall declines that our team identified since 1900. And for those who've been following us know that we have been calling for that waterfall decline to lead to a V-shaped recovery. Not a square root, not the markets would be flat the rest of the year, but that we would rebound sharply and recover the old highs. That happens 17 of 18 times whenever you have a waterfall decline. In fact, that's what's happened. We're back to the all-time highs now. And you may be wondering, does that mean stocks are just going to go up to the old highs and that's it? That's not our view. Our view is that the market is in a better place now than it was in February when we made our old highs, because there's deregulation ahead, there's tax cuts ahead. We have a lot more understanding of tariffs, which seem to have more bark than bite. And companies survived a stress test, which, as you know, when you survive a stress test and you don't fail, that means you're going to get a multiple expansion. So I think S&P can still reach 6,600 by year end. And that would be consistent with basically a bull market starting on April 7th.
Meanwhile, on May 28th, pressure started building against the Trump tariffs. In one day, two major rulings, one from the U.S. International Trade Court and another from a federal judge in Washington, D.C., raised serious concerns on whether those tariffs were even legal. For now, an appeals court has paused those decisions and kept the tariffs in place until June 9th. Either way, the message is clear. The legal ground supporting these trade policies is starting to crack. Now let's hear more from Tom Lee as he shares his outlook on the situation.
On May 28th, the International Trade Court ruled against the Trump tariffs. Now, it didn't remove all of them, but it ruled against them. And on Thursday, May 29th, the D.C. District Court Judge Contreras ruled that tariffs are illegal. So it's two cases ruling against White House tariffs. But on the same day, the Federal Court of Appeals issued an administrative stay, which reinstates the tariffs at least through June 9th. But you can see this is getting quite complicated. And the White House is insisting nothing has changed after the tariff rulings. And in fact, Goldman Sachs highlights that there's many measures the White House can take to implement or re-implement tariffs. But ultimately, the White House is losing leverage, and it's taking us closer to the end game, because it's going to be difficult for the White House to re-escalate things when they're losing really court cases. And so I think what we're probably expecting is the White House to look for an off-ramp. Now, this is not a surprise because tariff threats have led to concessions, just like the Doge cuts, even though they're less than expected, have led to concessions. And even this budget and reconciliation bill, they don't have the cuts people are expecting in spending, but they have concessions. Now, hedge funds have increased their short interest recently, and that's contrary to what you expect, because when the market's rallying, you think hedge funds should be covering their shorts, but that's not the case. How short interest is increasing for the average stock. And there's still $7 trillion of cash on the sidelines. But maybe most importantly, and I've said this before, the investment outlook is better for stocks now, arguably, than it was in February 2025, because you've got tariff visibility, you have tax and deregulation visibility. The companies survived the fifth major stress test, which I've covered before, which argues multiples should be going up. And the Fed is arguably more dovish next year. Now, President Trump and Fed Chair Powell had a meeting today, but no surprise, it's not as if the central bank has changed their minds, and they're saying that they're going to support maximum employment and stable prices and will make the decisions solely based on objective, non-political analysis. Well, in my opinion, that means that it's going to be easier to make the case for cuts in 2026. Well, that's a dovish Fed next year, which is really, as you think about it, 6 months from now, that should be positive for stocks.
According to Tom Lee, the growing legal pressure is forcing the White House closer to a retreat on tariffs. It's hard to keep escalating a trade war when you're starting to lose in court. At the same time, the market is acting strangely. Hedge funds are increasing short positions even as stocks rally, and a massive $7 trillion remains on the sidelines. Still, Lee says the outlook for equities is more promising now than it was earlier this year. Tariff risks are becoming clearer, the Fed is turning more dovish, and companies have proven they can weather tough conditions. With rate cuts potentially on the way, the conditions are quietly aligning for another market run. Anyway guys, before we go, if you want to stay most up to date on the crypto and Bitcoin world, subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis. Trusted by over 50,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it gave you some value. I'll see you all at the next one, and as always, all the best.